Good morning, David. We will be looking at Barclays Bank, which signed an oil deal for about 1.1 billion shillings, whereby they'll be financing Marriott Drilling, which is an oil drilling company with Britain. We're going to have a look first at the Kenyan market, whereby we saw the Kenyan shilling holding its ground against the dollar at 87.5575 on Friday, and the local currency is expected to weaken on the back of importers buying dollars to pay the routine end-month supplies. Looking at the stock market, we saw the benchmark NNC 20 share index edging up 0.2% to close at 4,821.50 points. Our market watcher for the day is Brenda Githinji. She's a research analyst with Standard Investment Bank. Many thanks for joining us. Now, as we kick off with Barclays Bank, the financing deal that they got with Marriott, the British explorer, Marriott International, looking at it from a perspective of financing, and there's been speaking about getting into the asset financing business. Is this a new strategy that we're looking at?
Yeah, especially now that after Barclays became part of the whole Barclays Africa operations when they merged with ABSA, I think it has become more of a strategy for them to go back to do a lot of institutional lending and more specifically asset financing. And for them, they're able to strike these deals or have these arrangements because they can actually have the arrangements not just with Barclays here, but with Barclays in South Africa, with the ABSA group, in South Africa. So of course that gives them the muscle to be able to bid for a lot of these big lending deals and be able to actually get them.
It's Marriott Drilling, not Marriott International. Looking at it, the fact that it's coming months after they financed another multi-billion project with KenGen, which is Kenya's sole power distributor. Do you think this is a space that they're looking at, energy and oil? Is this the space that they need to be getting into?
I think they do, because of course infrastructure is one of those projects that when they take a while to pay off, but when they do start paying off, they really pay off for a long time. It's patient capital, but once it starts paying off, it pays off for a long time. And I think that's the route Barclays wants to go, because they are more of a long-term player in the market. They like longer-term projects, and of course, again, with the muscle from ABSA, they're able to get a lot of these deals.
So their balance sheet can handle all these projects?
I think the balance sheet can, but then again, like I said, they're not doing it solely on their own, because these are quite big projects, and of course they also have other lending agendas that they want to push through. So I think this would be part of a consortium or part of a partnership. Yes.
And looking at it from a perspective of its loan book, you saw the half year growing about 6% to 107 billion shillings. How do you see now this financing coming in, especially trickling into the loan book?
Of course, this financing is spread over 5 years. They spread it over 5 years, so it'll have obviously a positive impact in trying to push their loan book, and especially being part of lending an institutional investor also shields you from the perspective of non-performing loans. And we've seen a lot of banks suffering from non-performing loans, and non-performing loans have been going up. So obviously focusing more on corporate and shifting to corporate tends to shield their book. And Barclays is sort of a more risk-averse lender.
And the fact that they're also talking about getting into the SME space, the small and medium enterprise space, then how then does that feature? Do they still have room for the small and medium enterprises if they're going after the capital-intensive projects?
I think they do, and I think it is part of having a more optimal mix in their book. Of course, at the same time, you want to go for some SME lending and some retail lending, because it enables you to have a wider net interest margin, because you're able to lend these people at a much higher rate, because a corporate investor will obviously ask for a much lower rate and they'll have bargaining power. So you really need that mix between retail and corporate to enable you to have sustainable net interest margins.
All right, Kenya Commercial Bank is one of the banks that has the only bank that has not reported its half year. We have all the others. We have CFC, we have Cooperative Bank, we have Equity, all coming in at an average of about 15 to 25%. How do you see Kenya Commercial Bank performing?
I think it being a top-tier bank like Equity, like Standard, like Barclays, I expect their performance to be relatively around the same range. We've seen a lot of banks report quite healthy growth in net interest margins, and this has mainly been because of the decline in interest costs in the market. So I think we expect to see that, and from Barclays, I would expect to see a bit faster growth, because especially for them, they've been able to really push their loan book, and they've been doing a lot of aggressive marketing trying to push their loan book. So I think for them, I would expect quite a bit more faster growth, but really in line with other tier 1 banks.
All right. Now looking at East African breweries, which announced a 34% decline in profit after tax, and this was beyond expectation for most people this year, that are coming in at about 25%. Now the share price week on week dropped by about 6% last week. How do you see the share price performing this week?
I think the company will, I think it will still be weak. I guess the only thing that really helps East African breweries is if you consider it from a multiple perspective with other brewers around Africa and in the world, it's quite attractive. And I think a lot of people who buy East African breweries are foreign investors, and they look at it from a more global perspective. And from a global perspective, it looks attractive. But for us sitting here, we think it's quite a bit expensive. We think it should be trading much lower, especially because it's struggling to grow its beer volumes. There's a lot of competition within the beer segment, and also where it's registering its fastest growth within the spirit segment, and especially the high-end spirit segment. It's also beginning to see a lot of competition within that space. So I think EABL will I think it will struggle a bit before probably the Tanzanian market can take up steam and actually be able to contribute much more to its profits.
And of course, it doesn't help that the earnings per share was down 34% to about 8.5, and also the dividend dropped to about 5.5 from 8.75. Now, looking at it from a perspective of its fair value, where do you see the retail investors, especially since they're the ones who are punishing the stock, to fair it?
I think below 300. Anywhere around from 250 would be somewhat fair for the stock, given now its declining dividend, and now that it's becoming more capital expenditure intensive, and they're trying to really increase their capacity to try and show off this competition. So I mean, obviously with that capex coming in, then we would see the fair value come down a bit.
Given the regional diversity, we have them in Tanzania, we have them in Uganda and South Sudan, but if you look at those markets, they did not perform as well as expected. There was softening that was seen in Uganda. There's the duties that were introduced in Tanzania. There's the currency issue in South Sudan. How do you see the regional markets performing going forward?
I think Uganda has always been a bit tough for them. They've gotten quite a bit of competition in Uganda from Submiller there, and I think it'll continuously be that struggle between them and Submiller in that market. Tanzania, I feel, will pick up. Because really it's for them, it's sort of new because they sold off their stake in Serengeti, so I think it'll pick up. So I would say, I mean, Tanzania would be their major, I think, where we'll see most growth coming from, and also their regional market into Rwanda and Eastern and Central Africa. I think that's where we will see a lot of the growth coming in.
And of course, we have seen the competition also looking for the same pie. We have Heineken, we have Bimila, we have the government saying that they also want to privatize the Kenya Wine Agency, and that, of course, with efficient management, I would imagine that we'll also get into that space. How do you see that landscape faring for EABL?
I mean, yeah, like I said, EABL is just really going to struggle a bit. There's a lot of competition. They've enjoyed being the top for a long time, but right now there's been a lot of competition coming in. Like you said, a lot of American-based beers coming in, and a lot of the new people who are coming into the drinking age are beginning to drink a lot of those American-based beers, and it's not just about drinking your Tusker, and not just about the loyalty and the patriotism that you feel drinking Tusker. People are now veering off to other beers and finding other beers more exciting than just Tusker.
And considering that we saw their premium beers, the premium spirits increasing quite well, about 267%, and their beer margins are not as much as looking at the spirits. Is that something they need to consider, probably shifting to the spirits market?
Actually, I think they've been shifting to the spirits market, and we see them introduce quite a number of high-end spirit brands, and it's because, especially with the new laws in Kenya with regards to drinking hours and limits on drinking hours, people are preferring a lot more take-away home drinks, a drink you can buy and take away home. So it will be prudent for a lot of these people who are coming into the beer market, into the alcohol market, to focus on drinks that people can take away home. And we've also seen EABL invest in a new canning process, so that they can be able to increase their capacity for selling beer in cans, because that is what people are preferring more. And so, of course, spirits has gained a lot from that perspective. All right, Penny, thanks for joining us. We're talking about spirits and beers on a Monday, but I think we shall see how the will fare on that stock. Many thanks for joining us.